What are we going to need to analyze these projects once we have established the correct cash flows? What we need is we're going to set up some what are called Pro-Forma statements. So we're going to need to predict how these cash flows for the firm are going to change in the coming future if we take on the project. Right? So we're going to develop some income statements and balance sheet information that will occur if we take the project, looking forward into the future for the life of the project. And then we're going to use those income statements to develop the cash flows on which we do our NPV and IRR analysis. Now, as we mentioned in the last class, those cash flows are the cash flows from assets that we talked about way back in chapter 2. Right? So cash flows from assets is the money left over from operating the firm after we account for any investments required by the project during its operation. Okay? So specifically, the formula for cash flow from assets is operating cash flow minus the changes in net working capital. This is any investment in working capital that we need to make, like investing in inventory or changing our accounts receivable balance, minus any net capital spending. And this is any investment in fixed assets that we need to make. So do I need to purchase any machinery or trucks or equipment, or any kind of fixed asset investment comes here. So operating cash flow specifically is EBIT plus depreciation minus taxes. And what you can think about here is this is the pure cash account that's left over from the firm's operations. If we think back to a simple income statement, EBIT, or revenue minus costs minus depreciation, gives me EBIT. So EBIT is this measure. It's the operating profit that's left over after I've covered all the specific costs from operating, from building products, from paying employees, and after I've depreciated my fixed assets. This is what's left of revenue. And then I'm going to add depreciation back, because depreciation isn't actually a cash expense, it's just an accounting expense. And I want here a measure of the cash flow. And then I'm going to subtract taxes, because taxes are a cash expense. I'm going to have to pay taxes out of cash. What's left over is the money, the revenue, the cash revenue that's left after I've paid all of my day-to-day expenses. Then to get cash flow from assets, I subtract any use of that leftover cash that I need to make investments with for the project to keep operating. So maybe I need to buy more inventory with some of that cash. Maybe I need to upgrade some of my machinery with some of that cash. Cash flow from assets is whatever's left. This is sometimes also called free cash flow. And so whatever's left hopefully is a positive amount. In other words, hopefully I have enough revenue, cash flow revenue, left over after I've made all my investments to provide a positive cash flow, and that's what's going to generate a net present value for the project. If cash flow from assets are negative, then this means that I've spent more money than I have made from operating the firm, and so my investments in working capital or fixed capital outweigh my income from running the project, and so that means my financing needs are going to have to cover that shortfall until the project starts to generate positive cash flows. So here I've just attached a table that we saw way back in the first chapter, from chapter 2. This is the first lecture that we covered, where I detail the way that the cash flow identity works, how cash flow from assets has to equal to cash flow that comes in from creditors or stockholders. Remember, we have to raise financing from these investors if the cash flow from assets is negative, or if my cash flow from assets is positive, I'm returning financing, or I'm returning some of that generated profit to these investors because they've given me this money. Right? So I'm paying off my creditors by paying down loans, or I'm returning money to my stockholders by paying down dividends. Right? So we can look at the cash flow from assets, and then the formula here is for operating cash flow. For net capital spending, you see the formula is ending net fixed assets minus beginning net fixed assets plus depreciation. So I want to see, if my ending fixed assets is larger than my beginning fixed assets, then I've purchased new fixed assets. And then I want to add back depreciation, because I want to make sure that I'm actually seeing changes in fixed assets because of purchases or sales, and not just because of depreciation. And then change in net working capital is just ending net working capital minus beginning net working capital. So these are the formulas that we're going to use to analyze the cash flows and to generate the set of cash flows, which is the cash flows from assets that we're then going to use net present value and IRR analysis on to to decide whether to take the project or not. So let's get started. Let's look at a very simple, straightforward example, and we'll talk through one, and then we'll work a couple of examples by hand. So the first example we're looking at here's the income statement, what we call a pro forma income statement. This is a forward-looking income statement estimating the future cash flows for the project that we're going to take on. Now, just to make things easy on us, let's assume that this project is completely new. In other words, this project is not something that an existing firm is considering investing in. This is just us considering starting a completely new firm, and this project is all that the firm does. And again, you know I like to use burger joints as my example, so let's think about this as if we're going to open up a burger restaurant. And there's a bunch of things that we need to consider if our plan is to open up a burger restaurant. And the very first thing we need to think about is we need to think about the economics of the plan. And that means we need to think about demand. How many burger restaurants already exist in Boone? Is there room for another one? Right? What is the total demand? Could we estimate the total demand for burgers in Boone? Right? There's already 4 or 5 burger restaurants here. They serve different segments of the market. We've got, all from McDonald's and fast food burgers, all the way up to, say, the Cardinal and Ransom and things like that, selling, $10, $12 burgers, fancy meats, high-end burgers. Is there room for another one to fit in there? And if there is room, what's the demand room for this restaurant that I might potentially open? Right? So I need to sit there and think about that. And I want you to think about how difficult this process would actually be. In other words, how do you estimate demand? How do I go about estimating demand? Well, one of the more common ways is, let's say I was already the manager at one of these other restaurants and I wanted to be the owner of a restaurant and open up my own. Well, then I would have an insider's view into demand at my own restaurant, the one I've been managing, and I could think about that and try to extrapolate that to, okay, is there more demand? Did we always have a wait? Was I always turning away customers? Were we ever empty? How many burgers was I selling per month, per year, per day? Was that increasing over time? But that would just give me demand at the one restaurant that I had inside information at. How would I do for the rest? Maybe I could go, at the extreme, I could go sit in the parking lot of all the other ones and just count the number of people that go in and then make an estimate of demand based on that. Maybe I could make an estimate just based on, maybe in a simpler way, just based on the total number of people in the market. Okay, there's 40,000 people in Boone, 20,000 college students coming and going for 9 months a year. If every one of them buys 1 burger a week, maybe that's a high-end demand. If everyone buys 1 burger a month, maybe that's low-end demand. And I think about it like that. But this is not an easy thing. And if we think back to our simple economics class, we know that there's going to be a modulating effect on demand. And that comes from price. Right? Because I might have significantly more demand for a really cheap burger and significantly less demand for a really expensive, high-end, fancy burger. Or if I'm going to sell a $20 burger made out of Kobe beef and handmade bread every day, and I grow the lettuce on the roof, and I only chop the finest tomatoes, and I charge 20 bucks for it, even if it's worth $20, I'm going to have significantly less demand from, say, somebody who wants to get a burger at lunch and doesn't want to spend $20 on lunch. And they want to spend $5 on a burger and go back to work. Right? So my demand is going to be modulated, meaning going to be changed by what price I charge for the product. Right? So I need to think about both of those things, and that's the first thing I need to think about, precisely because that's what is going to affect the top line of the income statement. Sales is the number of units I sell times the price per unit. This is the revenue that I bring in. And if I don't make enough revenue, everything else associated with the project is unimportant. So I estimate demand, and I decide on what kind of what place I want my burger joint to fit in. And let's say I want to fit it in at the Greasy Dive place. So I want to sell a really cheap burger in paper bags with fries dumped all over the burger in the bag, and I don't want to have to charge a ton. So I'm going to charge $4 per burger, and at $4 per burger, I'm going to estimate that I can sell 50,000 burgers. So my total sales, my total revenue for the year is going to be 200 grand. The next thing I have to think about is I have to estimate costs. And costs are two parts. First one is variable costs. So these are just the cost of making burgers and everything else associated with the burger joint. Soft drinks and booze if I'm selling it, and French fries and all the other things that go along with, maybe I'm selling ice cream shakes and things like that. And then fixed costs, which are going to be all of the more long-term costs that I exhibit. So my fixed costs are going to be my employee salaries and my utility bill and my rent on the location and things like that. Right? So I need to estimate my variable costs, and variable costs here, again, we can think about that. I need to source my meat, I need to source my vegetables, my bread, my soft drink mix, my booze, my everything else that's going to go into building a burger, ice cream if I'm making shakes. And I need to think about how all of those add up on a per unit basis. So if I've done that, I've estimated that for one burger it'll cost me $2.50 to build a burger. Then my gross profit is the difference between my sales price, $4 a unit, and my variable cost, which is $2.50 a unit. So gross profit then is $200,000 minus $125,000 or $75,000.